All right, guys, you've stumbled upon this video because you're thinking about buying a house. Today, we are going to be breaking down a $400,000 house and what you need to do to qualify for that house. So this is all gonna be test subjects. We have a test file going for the loan, which Tyler's provided here. And then I have a test subject on my new construction that's getting ready to go live, which I've had many videos on this channel showing this new construction, and we're getting really close to taking it live. So I figured it'd be a perfect test subject to see what you need to afford this house. Now, we wanna state that one, everybody's file is going to be different and everybody's transaction is going to be different. So I don't want you to take this. I want you to take all this with a grain of salt.
100%.
But for the most part, like, this is a very general overview of what a loan breakdown would look like for this scenario. Now, for this scenario, what's the credit score at?
By the way, just so you know, we are doing 430,000.
Yeah, we're going to do 400, and then I'm going to get over the new construction stats here in a second.
Okay.
All right, so
for this test file,
what is the credit score at?
Credit score is
going to be
the credit score is 800 on the test file, so it's pretty like perfect credit. So just grain of salt there as well. Credit score will affect the rate. You might have a little
typically 740 and up is
like really excellent credit. Yeah.
Okay. If you get below that 740 threshold, you can expect a little higher rate. Sorry, on the new construction, we're going to actually list this at 430. So we're actually a tad bit higher than 400 grand. But again, without pulling some random listing offline, I know this house pretty well. So new construction's in Orange County. It's 430. It's a 3-bedroom, 2-bath on a Rambler, couple of acres, and it's new construction. One caveat with new construction we should also talk about is taxes are not published yet, because the taxes that house will not be assessed with the county until a couple months after the build. So we are kind of going off a rate of other houses in the area, plus there's a couple formulas that they're going to be using if we were actually running this as a real file.
Yeah.
But so we're just kind of estimating today.
And that's also kind of a good point. On most factors, I try to estimate a little bit to the high side, just to give some cushion room, because you'd rather think you might need X amounts, a little bit more than you really need. Just like with taxes, I'd rather estimate a little bit over, and then you figure out, okay, I don't need so much more taxes. Just helps, you'd rather be a little over and then come in.
Yeah, my new construction's all over the place. They ended up giving me a check back after it was assessed of like $1,200, so we're extra in my escrow.
That's a nice check to get back, yeah.
But then they ended up hitting me again, saying I essentially need the $1,200 again. It was a mess.
Yeah.
And that does happen, but
100%.
All that being said, this is a FHA loan breakdown.
Okay, yeah,
wait,
that's good.
Sorry, is that it?
It is FHA.
You were about to say?
No.
Okay. All that being said, this is a FHA breakdown. Every loan product is going to be different: conventional, VA, USDA, VHDA. There's a pile of different programs out there. FHA, I think, is a great first-time home loan.
Yeah, I decided to go with FHA for this because it's probably applicable to the most people.
Right.
The vast majority of loans are conventional usually. Lately, FHAs are used a lot more for many different reasons. It allows for a higher DTI ratio. It has a lower interest rate lately, all kinds of reasons. But with any good lender, especially myself, I'll run all different kinds of scenarios for you to let you know, hey, here's what conventional looks like, here's what FHA looks like, here's what USDA looks like, just so you can see what's the best option, what makes the most sense.
Right.
It also requires less down payment for FHA. So
right. So it's a good starting point.
100%.
And potentially you can get into better programs.
In the question of, hey, how much do I need to qualify for a $430,000 house? Now, every area is a little bit different. For your area of the country, wherever you live at, this is for a Virginia home, so our taxes will be a little different than California or whatever. Roughly, you probably need to make somewhere around $6,000 gross per month to qualify for this whole, if you don't have any other monthly payment.
That's stock bare bones, because FHA allows a 55
on the upper limit. You want to stick somewhere around 54.4% DTI. That's debt to income ratio. Taking all of your debts against your income, and the new debt being the home as well. And then a ratio of that, hey, where are we at? How much of your income is taken up by all your payments? And you want to be somewhere around 54, 53, 52, and the lower the better to qualify.
Right. So
for FHA.
For FHA. So if you make $10,000 gross month, $5,000, you're going to be a payment, give or take. It's going to be a tad bit more than that. Is what you're going to be allowed. Now, if you have a $1,000 car payment on that, $9,000 now your gross income, and you divide that by 53%.
Yeah, so you can quickly see how all of your monthly bills will start to really affect how much you can qualify for.
Right.
If your monthly bills, and granted, it's a lot of people have this question sometimes too. It's just what shows up on your credit report as far as like credit card, car payments, your electricity bill or something will show up on there usually. So it's like what's on your credit report, your solid liabilities. But that will start taking away from how much of a home you can qualify for.
So let's run the scenario. $10,000 gross income minus, let's say, $1,000 car payment, which is surprisingly not unheard of nowadays. Let's say that they make, they have $500 in student debt.
You say $500 total student loan debt.
They have a small loan of, say, $150, a personal loan that's going out.
Let's just do another $500 for like credit cards, personal loans, like wrap up all their debts.
Wrap up all their other little debts.
Any other miscellaneous.
So that's $8,000. Now we would divide this number by 53%.
53%
times 0.53.
Yeah, there you go.
42 would be your what?
That would be the monthly payment that you would want to stick around or under.
Yeah,
and that's
which would
total month. So just the monthly payment we're going to be using the principal, interest, taxes, insurance, HOA fees are used for qualification as well. So any little factor that might affect the monthly payment will be added up into that.
Right.
And that number, we just took out all the other debts. Yeah, so that would be the housing payment. So you have to keep below that number. And you can quickly see how interest rates will affect that heavily. The loan amount, how much money they're putting down. So you can really do a lot to affect that monthly payment to be qualified for more. But that's a good method to kind of figure out, hey, how much of a house can I qualify for? Yeah, that's giving you the payment that you might need. But that is, just keep in mind, it's everything. That's taxes, insurance, HOA fees, if you have like
9 yards.
Yeah. So, let's go to see it.
So now we've talked about essentially just to qualify to get this kind of loan. Now we can talk about down payment, what you would like to see, and reserves as well. And then what I would need to see from the real estate aspect, what I would feel comfortable them walking in to do this whole process.
So this, it's kind of just a rough estimate, and a lot of this quote is estimates, and numbers change. It also, I'm usually estimating to the high side. I'm including fees in here that might not be needed. There's an appraisal rush fee. You probably won't need that. It's just kind of including everything that you might need. So it's going to be a little higher than usual. Also, depending on when you close will affect how many days of interest you need, how many months of escrow you need. So this is all a little bit subject to change. But roughly, on an FHA loan at $430,000, you need at least a 3.5% down payment. So that's the $15,050, the bottom left corner of the page there. And then your total cash to close is that $26,500 number. Now, that will always be lower by the time you get to the closing table because you're going to pay for an appraisal during the process. There's certain fees and things you'll pay for during the process. Also, things will be balanced, so the taxes might be balanced a little bit lower. That number usually always balances out to the lower than that. It kind of estimates to the high side again.
That's a good rough number. You have a final home inspection. Again, that's going to be paid outside of closing. Yeah. So it's not going to be really taken into effect on here.
For sure. So there's certain fees, but it's just good to know. You'd rather estimate to the high side just be comfortable. Okay, we know we need it. This is like an overestimation, but somewhere in this ballpark, really close. I would say somewhere around 26,000. Now, the good news is, and this is, again, it comes down to having a really good realtor, and sort of Ben would come in, is some of that could be paid by the seller. Just depends. They're totally market driven. But the factor to keep in mind is that down payment amount needs to come from the borrower themselves, or so if you can get gift funds from certain different loans, that's kind of getting into the weeds. But the seller credit can be used for closing cost assistance.
Offset that. It can never go towards the down payment. Down payment has to come from the borrower or gift funds.
Yes,
but it has to come from the borrower. It cannot come from the seller. Now, there are crazy things you can do with like a VA loan, and we don't have to really get into that, but you can start paying off debt and other crazy things.
This is where it's good to have.
And it's very market driven though. We cannot say that enough. The last 4 years, getting closing costs has been an absolute grind
but
from
we
a
have
seller.
gotten them.
We have.
And this is where, to give total credit, I mean, it's very sincerely, having good representation, good professionals that really know what they're doing does matter, because you can get seller credit. You can pay off certain loans at closing. There's all kinds of little intricacies to these programs and to the realtor side of the game that it matters, and you actually can get benefit from it.
Right. So we talked about the closing costs, which is the $26,000. That's going to be your closing cost plus your down payment.
Plus down payment.
That's what would you like to see from this borrower on top of? We've talked about the gross income to qualify for it, but what would you like to see in their bank accounts and/or other cash reserves?
Yeah, so it's a great question. I would say there's probably like two different answers. There's like the buy the book answer to be qualified, which is technically speaking, if you have like 27, in the bank, you're going to be qualified. You'll be okay. Now, I would always recommend to borrowers to have 2 months reserves, 3 months reserves of like extra payments in the bank, have a couple extra months in there. The good news is in most scenarios, again, talk with your lender, talk to the realtor, but there's usually ways to where if you close a certain portion of the month, you can skip the month after your first payment and you'll have a payment to the month after that. So it's nice to have.
Free first month, although trust me, you're paying for it.
Well, you're paying for interest. You'll see it on here. There'll be interest cost on here, but you are skipping monthly payments. So that's kind of nice.
Yeah.
But yeah, in general, I would say having 2 or 3 months of that monthly payment in your bank account is nice to have. It just, you feel comfy. You can make that payment when it comes up. If something happens, if something crazy happens, you have that payment saved up. But yeah, technically speaking, in certain loans, in certain scenarios, might say, hey, we want some reserves. And and that is a factor when I go to run
my
rates.
Second home.
Yeah.
They wanted two months of reserves. But that also accounts for 401k and investments as well.
Yeah.
So
that's kind of like getting in the weeds on the professional side of things. But there is having reserves that can only help and not hurt. I mean, there is certain loan types that might require it. Some loans might go, hey, we need to have 3 months of reserve or 3 months of reserve.
So then you see down the bottom right corner, which is your principal and interest, and that's your actual loan balance plus the interest on the loan. And then you have your insurance, taxes, mortgage insurance because it's FHA, lifelong mortgage insurance. That's why people always say put 20% down, which is very old school thought about it, but you don't have mortgage insurance at that point.
Yeah.
That being said,
on a conventional loan,
mortgage insurance in some scenarios, depending on your credit rate, like FHA could still be a better product if you don't have a great credit and you're going conventional.
100%. There's been a couple different scenarios lately, especially where a conventional loan might have a higher interest rate or might price out higher than just going FHA and paying PMI. And that's where I would run different scenarios for you and let you know, hey, this is what makes more sense. But 100%, there is scenarios where you'd rather pay a little bit more PMI, but have way less interest rate, and then maybe in the future refinance out of it. Or there's ways down the line to not have that PMI. But that's, I get a question a lot, hey, what is mortgage insurance? It's on every conventional loan with less than 20% down, and every FHA loan has it for the life of the loan. And what it is it's insuring against default. It's basically everybody's paying into this insurance pot, and if someone defaults, then they use that insurance money to pay for the default.
Yeah, government-backed loan.
Yeah.
It secures the money. So then the total payments, $3176, $430,000, which used to be probably around $2,000 a month.
Yeah.
With interest rates, we're playing ball. Yeah. Now they're not, but
that's probably a whole other tangent video. On the payment, I was going to say, we're talking about rates and the payment being high, but what is nice right now is you're against a lot less competition. Like people keep talking about, hey, well, rates are kind of high right now. I don't know if I should buy or not. Well, your competition's pretty low because not a lot of other buyers are out there. When rates do come down a ton, competition goes up like crazy. Now you're competing really hard, so credit is definitely out the window usually, and you might be paying over for the house. It might be, instead of this house being $430, it could be $460 or $490 because you're competing against other people.
Right.
So, and then if you get the house at $430 in the future, you can refinance. You always have that house. You have, it's yours. You can just refinance in the future.
Now, and we also have a whole nother video that I'll link up as well for rate buy downs, which could help with this offset this price, which I think in this scenario, if you look up at...
I don't think I included any rates or any points on this.
Oh, okay. Yeah. So if you look in this scenario, this is strictly like what it would be costing today.
But at 100%, you get that rate down to a 6.5 or a 6.25 or a 6% by paying points towards the rate. And then there's a whole video we've done on what points are and how that works.
Yeah. So I'll link that up in the corner for you guys to check out. One of our best videos ever. So yeah, total payment $3176. You'll need a little bit over.
Yeah, I would say
about $6,300 a month to actually afford to qualify for this house. Now, whether you think that's right or not, that's just based on qualification, and that would be your max qualification, which I would never recommend. I would always like to see you stay around that 30 or 40% of your net
income,
much more comfortable,
but
versus, 30% of your gross income than say 50%, because that's.
I will say,
I don't want you calling me 3 months after you buy it and saying we can't afford this house, and then we try to sell it because 100%. It's not going to go well. I can promise you that.
100%. What is good is this is total income for the household. So let's say you and your spouse both bring home $3,500 a month gross. That's perfect. Granted, you'll both use both debts, right? So I get that question a lot too. Like, well, I'll add on, a co-borrower and they make X amount of money, is that going to work? It's like, well, yeah, we can use their fund, their income, but also their debts will carry over too. So
and their credit scores.
Yeah,
So
and their
yeah, I mean, if they got a terrible credit score, which really is not going to matter a whole lot with FHA, but back to that, yeah, it still affects it. Yeah, I've had that a lot of. I've had plenty of times where it's like, yeah, my boyfriend makes a lot of money, and then we come to find out, well, he's got like a 400 credit score or something like that, and then he can't even qualify for the loan. So it doesn't really matter how much money they make, and or a lot of debts.
Yeah.
It doesn't matter if they're drowning in debt.
Yeah.
So
just something to keep in mind. But that's good too. Is a lot of people hear that number like, oh man, $6,000 a month or $7,000 a month or $10,000 a month, and it's like, man, that's like quite a bit of gross income per month. But that's also for a household. That's 2 incomes, not too far off for a lot of households. So it's just good to keep in mind. If both you and your spouse bring home $4,000 a month or $5,000 a month gross, then you're meeting that number, and you can still purchase in that range depending on your debts. So.
Right.
Keep in mind.
Because it's not about how much money you bring home, it's how much money you can save.
That is the truth. That is the number one factor is debt to income ratio. That's everything. So if you want to prepare to purchase a home, just really watch how much is on your credit cards, what your car payments are, keep your debts low, knock off any monthly payment you can, because you'll be able to afford a lot more of a home, and it'll be more comfortable to get out.
And cash reserves too, just in case something happens to your car. You're not running out and financing it and adding another payment to this whole scenario.
100%.
So, or something happens, whatever.
But
any case scenario. So
the approach covers everything.
All right. So I hope this helps, guys. If you have any questions, of course, like we gave you the 100 disclosures up front, everybody's going to be case by case. The best thing you can do is talk to a local lender, and I truly mean that. Local lender. Call Tyler and let him run your scenarios for you. Everybody's going to be individually different there. So if you guys have any questions, we'll link Tyler's information down below. You can reach out directly to him. If you guys need help with any real estate, of course, I'm always here for you guys. We'll see you on the next one. We'll put a link at the very end to a couple of other, like our rate buy down, a couple things like that. So, all right, guys, see you on the next one.